Good afternoon, everybody. Thank you for attending. For those of you that I've had the pleasure to meet, good to see you again. I know UF being such a small boutique institution, I do know many of you. But really, it's a pleasure for me to be asked to talk to you today. And I'm going to go over just really some fundamentals of investing. And at the end of the presentation, as you have questions, please hold them till then. And address them. I know it's probably more current market things and stuff as far as the state of the economy and what's going on around us each and every day. And I'll be happy to give you my opinion and discuss that. So let me go through a few items before we start, just so you know. I've been with Wells Fargo for 10 years, but I've been in Gainesville since January of '93. Grew up on the other side of the street, so to speak, with Barnett Bank, for those of you that have been around a long time, and rode the gamut through Bank of America, Merrill Lynch. And then I wised up and came to Wells Fargo. I've been doing this for now 33 years. So I've got a unique perspective through a couple of wars, rising interest rates, lower interest rates, currency crises, Y2K, 9/11, housing crisis, financial crisis. There's always something around the corner. We're in the middle of one now, coming off of COVID, and now with rising inflation and everything occurring, another crisis, but there's always different ways to address it through your advisors you work with, which hopefully Wells Fargo is one of your trusted advisors, but certainly seeking out information as you're doing today. So with that, let me just go over a few items as far as this presentation, and then we can get to your questions. So on a fundamentals of investing, I know it's a very generic topic, but it's something that we all need to start from one way or another. So everybody needs to spend some time, whether it's working with a checking account and a savings account when we start as a child or when we get our first job, to dealing in what many of you are probably inquiring about now: retirement, college planning, second houses, income planning, dealing with stocks, bonds, mutual funds, and a lot of different things. So this is going to go over that a little bit. Why do we invest? Well, we're trying to prepare for things we may want or things we may need. Again, there's a lot of things we want, but there's plenty of things we need. Eventually, when we're done working, since we all find success in doing a job and getting paid, we're going to have to replace that income at some point in time, and that gets difficult. So retirement planning is one of the major things that we do every single day and that I get involved with. The second one, and it's a challenging one, but it's education planning for children. If you're fortunate enough to have kids, some of you may have already taken them through college. Some of you might just have them in diapers still and in between. There's challenges as far as parenting, and there's challenges in higher education. You all work for a university, so you know a lot of those ins and outs, but planning for that and the cost associated with it does have its challenges, and there's a lot of planning involved with it. So those would be the two most common reasons. There's always other things that are involved, but those are the two primarily that I'll focus on with this presentation. So when we get to retirement planning and why you go into this and why you even invest, you go through a lot of different things. And the challenges that we have is Social Security, as it was set up years ago, just is not providing us what we need. And it's something that is a supplement, always intended to be a supplement, but many people at one point in time may have been able to live off it. That's not where we're faced with today. Social Security is about 25% of our retirement plan. Pensions or 401ks, or in the case of university, a 403b, is another 25%. But where's the rest come from? Some of it's our homes, real estate, second homes, other properties. We might have annuities. There could be inheritances. We might have individual IRAs. We may own some stocks. We get some dividends. there's a lot of pieces to this puzzle, and they can become challenging in understanding, or as the world changes around us, are we in the right thing? You know, I may have held an investment for the last 10 years, but does that mean it's good for the next 10 years? I may have held something for 10 days, and is it still right to hold it the next 10 days? These are the things that we can always look at on an ongoing basis, but really, we have to account for how do we replace the income for you to continue to do the things you want to do in retirement. And there's a lot of different aspects that we can go into, but it's all individualized to you and your plan. Our challenge becomes, especially with Social Security, is they keep raising the age on us. So the younger you are, the later you're going to be able to get full Social Security benefits, which raises a lot of questions as far as, is Social Security still going to be around? Are they going to means test it? The challenges we may have ahead of us, that maybe that 25% isn't even a possibility. So right now, the full retirement age is 67, but the rumblings out in the marketplace is that this may increase. They're already increasing the required minimum distribution for what we need to do for our IRAs, our individual retirement accounts, once you're done working, where you move your 403B to. That has increased from 70.5 to 72, and now it's 73. This is going to keep going up. And that means the government is taking a look at how they're going to maximize getting taxes from us. So you get in a tax discussion as well as an investment discussion and an income discussion. It's very daunting when you don't do this every day. And a lot of people sit around at 10 o'clock at night in their pajamas, pulling up their portfolios. Hats off to you if that's what you're doing. That's not what keeps me employed. What keeps me employed, since I do this every single day, is helping each and every one of you do that planning, take a lot of that burden off your backs, but also just providing you information like we're doing today, so that if you are doing this on your own, or even if you're not and you have advisors you're working with, which hopefully you are, it will give you a little more insight and be able to ask more questions. Hopefully that's what it provides you. So as the government's trying to determine how we're going to tax you and why they keep raising the age, that's because the older they have the age limit as far as when we can access monies, whether it be Social Security or IRAs, really, the less we're going to live. You see, if you retire at 40, you've got 41 years you got to plan for. If you retire at 65, you got 19 years to plan for. With the government increasing the age, it's less time that they have to be on the hook, so to speak, for income supplements, whether it be Social Security and other things, and other entitlement programs. So they want to try to stretch that out as long as possible so that it may leave more in the pot, so to speak. And they're not as much of a burden. But everybody I sit and talk with, whether they're a 22-year-old just graduating out of college, or they are a 72-year-old that just decided to retire, they're all concerned with running out of money in retirement. Of course, the younger you are, and if you retire, the longer you got to plan for. But it's all about planning and getting the right allocation that's going to meet your needs of how you want to live day in and day out. We live a certain way now, but when you retire, it's a different chapter. Somewhat scary and challenging, but if you plan properly, it should be one of the best times of your life. The second one primarily is education funding, education for our kids. College costs continue to rise. You take a look at where we sat just a couple years ago, public institution, 4-year annual cost. And this is just for the tuition, room and board. $23,000 for public institution. So somewhat like a UF. Private going $52,000. You fast forward what the projections are in just 15 years, we're going to go up 50% within the public institutions and almost 60% in private. if we're not planning accordingly, this is a huge challenge. And most people miss the mark. They miss the mark, and it leads to borrowing money, taking out loans, whether it be student loans, home equity lines, personal loans. The government's not handing out as much in aid as they used to. For a need, yes, but with the cost going up, it's just missing the mark. So that raises a lot of challenges as far as planning for this and sitting down and just trying to get a feel for whether it is a public institution, a state-run public institution, a private institution. What can we plan for? We want the best for our kids, but we have to be realistic about what we can do. And it's probably one of the most challenging and scariest aspects of my job that I do day in and day out. But if you don't plan for it, it just will be difficult. There's no easy way to put it. It will be difficult, and it could set you back for years. Earlier you plan, the better, whether it be a Florida prepay, which is an excellent program. Also dealing with 529s, education IRAs. Those are some things that we can use. And that's sort of what we get caught up in. But within those investment things, whether it be with education or retirement, what are we putting our money into? Well, stocks, bonds, mutual funds, ETFs. Words you hear, but do you know what they are? An individual stock is shares of a company that you become an owner in. But if you just own shares of a stock in a company, you own one thing. I equate that as simply as I can is, if you got a pencil nearby and you just hold it with both hands and you try to snap it, you'll probably be able to. That's one stock, one company. If it goes down and it breaks, you essentially got something that doesn't work anymore. Now, if you grab 10 pencils, put them together, hold them with both hands, try to break them, probably not going to do that. That's a crude way of showing a mutual fund to you. Mutual fund is a collection of stocks. Safety in numbers. It's kind of the basics as far as what you get into with that aspect. And many of us invest in mutual funds. That's what's in your 403B. There could be some ETFs that are in there. You might have cash alternatives. A lot of times we start with checking and savings accounts, as I referred to when we started our investing world, and then you go on to things like stocks, things like bonds, which could be CDs. The banks offer those. They could be treasuries. Treasuries are offered by the government. They could be corporate bonds, debt instruments offered by corporations. They could be municipal bonds. Obligations offered by local municipalities. Then you get into mutual funds, as I referenced, and possibly exchange traded funds. Now, exchange traded funds are a little more transparent mutual funds that trade every single day. A mutual fund, the managers may transact during the day, but they settle out and you only have one price, and that's the closing price each day. Whether you're buying it or selling it, you get that closing price. An exchange traded fund is that same mutual fund, but it is trading second by second, minute by minute, much like a stock does. So you can see what's happening and you have a price as you go throughout the day. So a little more transparency in what you're dealing with, but yet you still have the same safety in numbers. Now, all of these investments involve some level of risk. Principal loss may be possible, whether it be in cash, so to speak. Cash is king, cash is safe, but if you're invested technically in a money market mutual fund, it's a mutual fund, there is some layer of risk. Although I'm going to tell you 99.99% of the time, you don't have anything to worry about, but we certainly had worries in 2008. Checking and savings accounts, if you're under $250,000 through the bank and the FDIC, shouldn't be a problem. Recent developments show you that the government was willing to insure institutions over and above that, which may be some questions you have. I can go into that. However, there is risk over $250,000 at any institution, so you have to watch that. Bank CDs the same way. Get over $250,000, you may have some degree of risk if the bank goes under. Now, stocks may go up and down. Stocks may issue dividends. Stocks may offer some type of total return that you're looking for as far as growth. These are all things that we can go into on a broader scale or more individual of where your risk is and what you're looking to do. Even with bonds. Bonds are fixed income investments. They can be income replacements. They will have a set interest rate. They may have a maturity date. They can offer some liquidity. There are problems sometimes with inflation, as we're dealing with now. If they are called or paid back early, there are some risks involved with bonds. So there are some challenges there and some risks that we have to watch out for. I'm just going to slide through some of these because they're a little more specific. Now, when you get into a point of how to invest, and if you have an advisor, you've probably gone over this, but in general, it's all about an allocation. How do we allocate our assets to meet the needs? Do we want to be aggressive? Do we want to have a lot of money in stocks? Do we want to have a lot of money in bonds? Do we want to be conservative and just keep it in cash? A general rule that I start any conversation of asset allocation with customers or prospective customers is this. Take 100, subtract your age. That is the percentage you should have in stocks. So with this screen, this would be a 25-year-old. Take 100, subtract your age, 75% should be in stocks. That's a starting point. Some people want to be more aggressive. Some people want to be more conservative. We can get into those discussions, but this would be a generic look at an allocation of a 25-year-old, a generic allocation of a 50-year-old, and a generic allocation of a 40-year-old. Now, this last one I just leave up there for a second because a general rule is through time, a 60-40 allocation gets you home and replaces your needs. That's been challenged of late just because when you have a negative year out of the stock market and when you get rising inflation and the interest rates aren't keeping up with inflation, this becomes challenging. So then you have to get in with your advisor and talk about what parts of stocks or mutual funds or exchange traded funds make sense. And is 60% worthwhile? Maybe we should go to 70. Maybe it should be 40. That's something you have to do individually and develop, again, that plan. Now, where can you go about investing? There's a lot of different places. Your employer-sponsored plan, university offers a 403B. Hopefully everybody is investing in that. If you're not, please start yesterday. IRAs, individual retirement accounts. Individual retirement accounts let you put money each year. Now, there are income limits. There are other things that are involved. But generally speaking, in an IRA, if you are under the age of 50, you can put $6,500 into an IRA each year right now. That is the 2023 maximum contribution limit. If you're over 50, you can put an extra $1,000 in. So that's $7,500. With the 403B or 401k, your minimums, well, your maximums for 2023 is $22,500 if you're under 50. If you are over 50, you can do a catch up. So you can add another $7,500, which brings your total that you can invest for retirement to $30,000 in an employer-sponsored plan. For education, a couple different means that you can go to. A 529 savings plan that has special tax benefits to you. We can go through those particulars on an individualized basis. The Florida prepay is a form of a 529, and 529 is the tax code section that college education comes into, as well as educational savings accounts do have some benefits to it, and they all have different particulars as far as how much you can put in. With the traditional IRAs, you have to have earned income or you can't make a contribution. contributions might be tax deductible. Always got to check with your tax planner on that, because there are income limitations and other things. The investments that you go into, if you want to grow it, you can, but everything in there is going to grow tax deferred until you pull the money out. Once you start pulling the money out and you use it for income, that is when you will be taxed. And anything, whether it be an IRA or even your 403B, any distribution is taxed at your earned income at the time. Roth IRAs. Now, this is a form of an IRA. My opinion, probably the best piece of legislation put in the last 30 years. You are able to make contributions to an IRA, but you don't deduct this for taxes. This is an after-tax contribution, but as long as once you establish the Roth IRA and you hold this for 5 years, anything that it had grown, once you distribute it, will be tax-free. Now, there are income limits, there are other requirements. Again, consult your advisors to that, but this is something that things can grow tax-free once you distribute. So we can go into those particulars, but again, a Roth IRA, probably one of the best pieces of legislation put out in the last 30 years. The different types of plans that you may have. If you're self-employed, you can get into a SEP IRA, potentially a simple, the 403B, which most of you have access to, or a 401k. Education purposes, 529 plans cover a lot as far as when you distribute. The various things, and there's even more that we can get into here. But again, why do you use this? Because it does have tax benefits and it gives you an outlet to save for retirement or for your children's education, sorry. You control the assets of where it's invested. There are state-specific plans because there's tax benefits for different states. Since we're in the state of Florida without a state tax, we have the ability to go out and look at any plan offered through the country, which there's some 35 plus. The benefits of the 529s, as far as your assets can grow tax deferred, both federal and state. If used for qualified education, it becomes tax-free. Again, consulting your advisor and where this fits into your plan is my suggestion. Education savings accounts. You have a smaller ability of adding some money, but I will use these in circumstances because you can make contributions, and it's always good to have available for some of the smaller expenses or little things that your child may need. Again, income limitations as far as your eligibility and other things. So now from this standpoint, what do we do now? Well, hopefully you sit down with your advisor, you contact us, we'd be happy to help you. You go into different things. As far as where can we go? What are we trying to accomplish? How many years before we get there? There's a lot involved in planning. Hopefully some of you are well on your way. For those of you that aren't, that's okay, but you probably need to sit down and have a review. It's something we offer, it's complimentary. Reach out to your Wells Fargo banker, have them look for me. There's my information as far as on the screen, where you can contact me. My office is out in Hale Plantation. But again, anybody in town can seek me out or go to your own institution, seek out help and double check either what you're doing, or if you're not doing anything, get some guidance. It's only going to put you in a better place. So with that, I will open up to questions, Patricia.
Thank you, David. We do have two questions. Does a traditional IRA include Social Security and other pension annuity income, or just earned from job?
Has to be earned from job. So it has to be W-2 or contract work, but it has to be earned from a job. You can't use pension income or Social Security.
The other one is, does changing employment mean I lose my 403B or Roth IRA through UF?
No. and you could check with your HR department, the money you put into your 403B at UF is always yours. If there's matching programs, because I'm not sure exactly what the program is, sometimes the match may have a vesting to it where you have to be employed for so many years before you're able to get the part UF contributes. But the money you put into the 403B is always yours. Should you leave UF and change jobs, go to a different institution or totally out of the environment of the educational environment, then you would look to do a rollover to an individual retirement account. You don't want to pull the money out because you'll be taxed. And if you're under the age of 59 and a half, you would be penalized at an additional 10% of what you withdraw from the IRS. So again, consulting an advisor before doing a withdrawal or anything out of your 403B would be my suggestion, but you can certainly take the money, put it in an IRA. It is always yours. You would actually gain more control of it if it's in an individual IRA for what your investment choices are, but you do not lose the money.
Thank you. And we do have a 403B and 457B plan webinar coming up on April 20th. UFHR Benefits and Fidelity, who manages those plans for UF, will be presenting on the 20th at noon. And I put a link in the chat for anybody that wants to learn more about those plans, so you can register for that. We do have a couple more questions.
Sure.
Is the SUSORP a 403B? I think that's more for the benefits team.
Yeah, it's asking about a SARSEP, I think.
The optional retirement plan, I think that's.
Yeah, that's going to be, yeah, it's an optional plan. You can get into particulars again. I would get with HR on that first, because that's different income limits of where you can save more for retirement. It is a possibility, but you have got different particulars on that. So something outside of my scope. I would highly suggest it if you have the ability to save more, but that's out of my scope.
Next question is, can you have multiple IRA accounts?
Yes. You can only contribute the max limit per year, but you can have multiple IRA accounts. You don't need to, because if you have an IRA, an IRA acts like an umbrella, and underneath that umbrella, you can have multiple investments. So you can make your contributions each year, and you can buy individual stocks. You might buy one stock one year and another stock the next. You may buy two mutual funds with your contribution. You can put anything you want underneath the IRA. So just because you're making an additional contribution doesn't mean you need to have an additional IRA. So from a consolidation standpoint, and just less paperwork, less passwords to remember, less things to monitor and to have them in one place, I highly suggest you do it in one place. But the short answer is yes, you can have multiple IRAs, but you can only contribute per year what the maximum limit is across all of them. So in the case of being under the age of 50, it's 6,500 again. If you're over 50, you could do 7,500 for 2023.
Following up, and I think it's the same answer, but can you have multiple Roth IRA accounts?
Yes, same way. You can have multiple Roth IRAs. Now, I've gotten this question before as far as can you have a traditional and a Roth? You can, but you're still subject to the maximum contribution limits of IRAs. The reason you do a Roth is if you qualify for it and you're able to do it, do the Roth, not the traditional. Simply put, the tax savings you're getting out of a traditional, if you can deduct it, is minimal if you fast forward 10, 20, 30 years of deferring taxes and ultimately that withdrawal being tax-free if you had contributed to a Roth. It's something I can show in individual meetings, hard to do in this environment. But if you're able to do a Roth, I would suggest that's where you go. The traditional is okay, but really it's phasing out. So I'd suggest the Roth.
The next one is, can someone roll over the 403B into their Roth IRA instead of rolling it into a traditional IRA?
Yes, they can. This is what's going to happen though. When you roll it over, and I'll just use the example, let's just say you've got $100,000 in your 403B and you want to move it into a Roth IRA. You can do that. But now you are going to pay taxes on the $100,000 because that money's never been taxed. So that gets into sitting down with your CPA or your tax advisor, sitting with your financial advisor, mapping through, does this make sense? Because you are going to pay taxes on that money. Once it gets to the Roth, now it will grow tax-free if the Roth is held for 5 years. So depending on your age, when you expect to use the money, when you expect to go into distributions, what your current tax basis is, that is something to consider. I do have clients that will do it, but I will tell you it's probably about 20% out of those that inquire, I can make it make financial sense. But it certainly is something you can do, but be aware there is taxes.
The next one is, can you explain what an annuity is and when it is a good investment?
Sure. An annuity in its core, so I'll start that way and then I'll try to expand the way it's expanded. An annuity in its core is you are investing money and investing it into an annuity, which means you are handing it over to a life insurance company. An annuity will then pay you a set income for the rest of your life that you can never outlive based on the mortality tables the insurance company has set. So if you hand over $100,000, the insurance company, based on your age, may tell you you're going to get $322 a month for the rest of your life. That's an annuity in its core. Now, annuities through the years have morphed into investments. There are fixed annuities, fixed indexed annuities, and variable annuities. As simply as I can put them, a fixed annuity is like a CD or a treasury with an insurance wrapper. It has a set interest rate, a set maturity date. The monies will grow tax deferred. You don't have to turn on the income stream when you make the investment because initially it is now as an investment. And when you choose to, at a later time, turn on the income, then you get into the distribution aspect of an annuity. But now annuities are more like investments. So that's a fixed annuity. A fixed indexed annuity is like you have choices where you can participate in some of what the market provides, but you don't have any risk to your principal. And again, that's where I should have started. Annuities are guaranteed of their principal, but they're guaranteed by the insurance company. Keep in mind that the FDIC, which insures bank deposits, was created from looking at how the structure of insurance companies were. Things like New York Life or Western Southern or Mass Mutual. They were around long before the FDIC were created, and the I for FDIC stands for insurance. So these are protected in their principal by the insurance company and their solvency. So on a fixed index annuity, you have no downside of your principal, yet you might participate in the upside of whether it be the stock market or the bond market. There are different features involved with them, which I can go into on an individualized basis, but understand that is a way to participate somewhat in the market, but have no risk. A variable annuity is out there where it's like a mutual fund that invests in stocks and bonds in the market. So it goes up and down in value, but has an insurance wrapper, which gives you two things. It lets you defer taxes, much like your 403B, and it does have some guarantees. However, the guarantees on a variable annuity come at death. What you put into a variable annuity will be guaranteed as far as when you die. There are riders that you can add to them that can provide various guarantees if it fits into your plan, whether it be a guaranteed income rider or other features. But a variable annuity is much like a mutual fund with an insurance rider. A fixed index is like investing in Vanguard S&P 500 index or the Lehman Brothers aggregate bond index with no potential loss of principal. And a fixed annuity is like a CD with an insurance wrapper. So they are fully protected by the insurance company. They may fit into your plan as far as an income supplement. I believe an annuity can be a viable investment for everybody, but yet an annuity is not an investment for everybody. It's something that is not a square peg that you try to jam into a round hole. It is very specific. It's for some of your assets, some of your allocation, but not an end all for everything. Sorry, long answer to a short question.
It's okay. This one's interesting. What are your thoughts on cryptocurrency and any information regarding investing in crypto?
I get that a lot. And this is my opinion. I don't like it. It's too early. You can make money, but you can also lose money very quickly. If you want to invest in cryptocurrency, my opinion is this: buy a plane ticket to Vegas, just put it on black or red, go to the craps table, go to the roulette wheel. I think you might have a better chance. Cryptocurrency always has one big overriding problem to it. The US government and the dollar can change to cryptocurrency tomorrow and it'll put everything out of business. So anything that's occurring right now as far as a valuation and using it as a currency, to me is a stretch. There's reasons why the marketplace has not deemed it as a form of currency officially. It is an investment. It may get to be a currency, but right now the mechanics behind it, as far as blockchains and the algorithms and everything that kind of puts it in place, they've got a lot of value and a lot of worth. But as far as the currencies themselves, too early. You'll see a lot of consolidation. There may be some that last, but with a big overwhelming piece that the Federal Reserve can turn to cryptocurrency, which they are looking at, that's going to trump everything. And really, you would see something like a Bitcoin maybe just drop like a rock if they turn that switch again at the Treasury. Now, that's my opinion. I just think it's too early and it doesn't have value at this stage. Yet you can invest. It has speculative value. But in my opinion, have fun, go to Vegas, get some drinks while you're losing your money.
Thank you. Do you have any research recommendations for people just starting to look into mutual funds?
Yes. You can find a lot of things out there from a periodical standpoint, but I will try to point you this way. Within your bank, whether you bank with Wells Fargo, and I'll reference there, but really this should be any bank, you can go on there and click on investing and education. We have materials there for both doing it yourself, working with an advisor, and other things. And you can have access to the research that we provide. Your bank or institution should be able to point you there the same way. Utilize the resources you're already in, but you just don't know where it's at. But if you go to wellsfargo.com, you're going to see a lot of different places that will help you financially, not just through your savings and checking account, your credit cards, or your mortgage and your car loans, but check the investment tab. We have plenty of resources there that you can access, as you would be able to at a Bank of America, Chase, a credit union, or anything. There's not a specific place, I would tell you, yeah, pick up investing for dummies. Well, yeah, you can do that. You're going to get information, but I'd rather be more current with kind of a economic or weekly update, or hey, here's some mutual funds and this is what they invest in, this is what they do. You can get that type of information from even your bank you're working with. That's where I'd start.
Okay. As an individual, how do I go about researching and buying corporate or municipal bonds?
Yeah, that gets challenging because you can do some of that on your own, but the bond market is challenging, even though it trades much like the stock market. I personally haven't gone outside of where I sit because I have access to a bond desk. But if you go online, whether it be using Wells Trade, our online institution, an E-Trade, Fidelity, any of those, there should be an outlet to research bonds. You should be able to put in particulars of what you're trying to accomplish, whether it's trying to get a certain yield. It should let you do a search around certain parameters. The parameters I would use is type of investment, whether you're looking at treasuries, municipal bonds, corporate bonds. What time frame are you looking for? Is it 1 to 10 years, 3 to 5 years, 10 to 30 years? A minimum coupon or a minimum dividend it may offer, you plug that in, and then you do a search. That search will bring up a list of municipalities and corporations, and then you have to feel comfortable with those. You can have a bond issued by Alachua County that you feel comfortable with, but then you could have had years ago municipal bonds issued by Puerto Rico that there was some defaults on and different things that occurred there. Sometimes you never know, and you have to entrust your advisor. They're going to have more information on the bond market and what's going on within corporate debt and municipal debt. But that's how you start. If you're doing it by yourself, go to where you're trading. And they should have a search aspect that you could plug in your particulars. It will pull up a list, and from that list, you have to be comfortable with what you're invested in.
Okay, are the traditional IRA and Roth IRA accounts under different umbrellas?
Yes, they are. Because a traditional is going to be a tax-deferred umbrella, and a Roth will ultimately be a tax-free umbrella. In order to make them into one, you can't move a Roth to a traditional, but you can move traditional to a Roth. But again, that gets into the previous question about, can I move a 403B to a Roth? If you moved a traditional IRA to a Roth IRA, you're going to pay tax on that traditional IRA value to convert it. And that's where you need to seek the advice of your CPA or accountant and your financial advisor. But they are two separate umbrellas.
Okay. How long can I contribute to a Roth IRA? And do I have to have an income from a job, or can I just use my pension?
No, you have to have income from a job. And you can contribute as long as you have income from that job.
For the Roth?
Yes.
Okay. What is the advantage of a Roth IRA versus a brokerage account?
Well, a Roth IRA is going to be in a brokerage account 9 times out of 10. You could potentially, I'd have to see, have a Roth IRA that just is a savings account or a CD. But most Roth IRAs are through a brokerage account so that you can buy mutual funds, buy individual stocks, buy ETFs, and have the different investment choices. So the majority of the time, the Roth IRA is in a brokerage account. And I would highly suggest that it should be. It could also be in an annuity, by the way. An annuity can also be an IRA. It is one of the investment choices for an IRA or a Roth. So again, it's some of those things that, again, a further discussion of where that fits into your overall goals when we get into a planning piece. But it should be in some form of a brokerage account.
What is the best way to begin investing in REITs? And if we can clarify what those are, REITs.
Yeah, REITs, it's a real estate investment trust. They are forms of investment that's out there that, again, invest in various forms of real estate. Sometimes it's commercial properties. Sometimes it might be rental properties. Sometimes it could be raw land. There's a lot of different variations that can come with those. They are managed by the company that issued the REIT. So they're the ones taking the money, buying into a strip mall or a an apartment complex or farmland or different things. A lot of times with REITs, they're going to be getting some type of payment back on the properties that they're in. So in a commercial property, they're getting that rental income from the businesses, and then they pass on a certain interest or dividend to you as a shareholder. Some REITs have a requirement that they have to pay out a certain percentage of all income that comes in. Again, the details of particular REITs, since they're all different in their structure, is best to sit down again with your advisor and go through them. Or if you're researching them yourself as you're sitting on the couch and going through your iPad and you're pulling up REITs, write the list down and take them to your advisor and say, hey, what do you think of these 3 or 4? And then you'll probably get a varying answer because they'll all have a little different twist to them. But it is a form of real estate investing instead of doing it yourself by going and buying an apartment and renting it. You let someone manage that for you, and you just buy the REIT, which is essentially doing that job for you. But you are now, much like a mutual fund, you're not just owning one property, you're owning multiple ones underneath the hat of that REIT.
Okay, the next one is tax loss harvesting was suggested to me recently. Can you explain what that is and are there
Sure.
resources at UF? I don't think UF has resources for that, but if you could explain for that.
Well, yeah, because you're not going to be tax loss harvesting anything that you're doing at UF with the 403B, but on your outside investments in your regular brokerage account, you're either going to have some unrealized gains or unrealized losses that's going on with your investments. So let's just say you had invested in Apple at 100 and today it's at 160. You have an unrealized gain of $60 per share. Maybe you invested in Tesla at 250 and it's worth 190 now. So you have a $60 loss in Tesla. Through the year, if you sold something, you would take in that unrealized loss or gain and made it a realized loss or gain. So a lot of times as we get towards the end of the year, when we see what our tax burden may be, did I have gains for the year or did I have losses? We will counteract that by, if you, in the case of having some gains, if you are holding some unrealized losses in your account, we will look to see if it is in the best interest to do some tax loss harvesting. Sell the position to create a loss so that you're not paying taxes on the gain to the IRS. So we're trying to match off gains with losses. It may not make sense, but it is something to revisit and should be revisited the last quarter of every year. That's what I do. If your advisor hasn't been doing that and you've been coming up with capital gains all the time, you probably need to have a different conversation or come see me and I can tell you what I get involved with. Now, you may go through a year much like last year where there was a lot of things down and there weren't gains. You weren't paying capital gains, but we had a lot of losses. Sometimes it makes sense to harvest those losses. Go ahead and sell them. Take the losses because the IRS lets you carry forward losses. And by carrying forward losses, you're trying to help yourself in future tax years lower your tax bill on any gains you may end up taking. Because we don't always have losses in the market. It's been a number of years since we did, coming out of the financial crisis, probably since 2013 through 2021. There were very few years that we had losses that we could match off. So tax loss harvesting was difficult. So now it's come back into vogue because we had a year that we had losses. So getting with your CPA, getting with your advisor and formulating a plan to either take care of the current year tax with what you've transacted through the year or trying to prepare for future gains by taking losses in the current year you have may make sense, and it might reposition the asset to a place that is better suited in today's marketplace. So again, that's just constant contact with your advisor on what makes sense, and then how does it play out financially with taxes.
Okay, we have 5 minutes to go and 2 more questions. So we're just gonna make those the last 2 questions before we
Sure.
end the webinar. Where would you recommend that I look for a financial advisor?
Right here. That's the easy space. Again, I'm biased because I sit in a bank environment, but I would start in a bank environment just because realistically, I got into this business years ago and I started as a teller when I was in college. And the reason I got into this business, and I was a finance major with an economics and accounting background as minors, I wanted to get into the financial advising world because I saw customers that would come in and have no idea what to do with their money. And you would see and hear stories that they went to a brokerage account or they went here or there and made these investments and they lost money, and it's challenging. So I'd start with somewhere you do trust. Your bank is a place that you've probably been with for a number of years. They should have some type of investment division. Sit down with that advisor. That doesn't mean you have to invest, but sit down, try to gather some information, try to formulate a plan. How would the advisor suggest? If you put 10 of me in a room, you're going to get 10 different plans. We're all going to have a different take based on our experiences and what we see happening and how we have seen situations like you're asking. Another place to go is, I know UF offers some help with advisors through your retirement plans. Seek that out too. They may not be able to see the other stuff you have, but that can give you a place to get some answers, and maybe they will take outside accounts. Sometimes they do, sometimes they don't. But I would start with a place that you know, sit down with an advisor. Even though we don't get into these discussions around restaurants or places with our friends, but friends that you know that might invest, you can always ask them, how do you feel about your advisor? Are you comfortable giving me their name? A lot of the clients I get come from referrals from my current customers. Because when I've been doing this for 32 years, I'm doing something right. At least I think I am. Otherwise, I wouldn't still be here. And a lot of that, comes from the faith and confidence of my customers. But when you start out, it's a lot of blind faith. So try to make it less blind by going to a place you can at least trust, and then sit down. If you're comfortable with who's sitting across from you and it starts to make sense, fantastic. I think it makes sense to at least go 2 places, if not 3, get different opinions, and then choose the one that makes the most sense for you. But that's where I'd start.
Okay, and the last question. When choosing ETFs to invest in, how important is it to see if the dividends are qualified or non-qualified?
When I choose to work with an ETF, I don't get caught up in the qualified or non-qualified. It's a minimal tax savings. You do get a little benefit out of qualified dividends, but I'm looking more at the structure of the ETF. What are they investing in? How long's the manager or the management team been in place? How long has this ETF existed? What is their strategy? Do they have limitations? Do they have minimums of an investment? What are their underlying expenses and fees? If I'm going into an ETF, a lot of times ETFs have lower expenses and fees. That's important to me in making sure that we're trying to keep as much in your pocket as possible. So I don't get caught up as much with the qualified or non-qualified dividends of an ETF or even a mutual fund in that case, just because I'm looking deeper into the merits of the investment and I'm not letting the tax ramifications make that decision. So in a top 10 list, that's going to be down near 10 as far as what makes me invest in that. Now, again, that's me personally, but if that is a big issue that has come up with you and your accountant when you're doing your taxes, there's a lot of qualified or there's a lot of non-qualified dividends. Let's start looking for more qualified dividends. Certainly that now becomes a larger concern, and I would start looking more that way. But in general, to answer that question, it's not very important to me.
Okay, thank you so much, David, for your insights. They're very valuable. And thank you, everybody, for joining us today.